Hi, and welcome to the spreadsheet help for Chapter 7 Stock Valuation. Okay, so the first model we're talking about is the constant growth model on the valuation models workbook. Okay, so example 1, I just follow this formula here, where I take the dividend and I'm going to divide this by K minus G. And this gives me the stock valuation of $102. So let's format that into currency. Now once I have this answer, I could just drag this across to answer all of them. And again, this is the constant growth model of stock valuation. So this video is just to show you how to calculate this in Excel. It's not to explain exactly what these models are. That is what the lecture videos are for, and also the textbook. Now, what if I need to calculate, they give me D0, but they don't give me dividend for year 1? Well, the first thing I'd have to do is calculate D1. So I'd use D2 multiplied by 1 plus the growth, G. And this would give me the new dividend. So say you made $2.25 an hour and you got an 8% raise, you're now making $2.43 an hour. So to calculate the price of the stock, or P, I again refer to this constant growth value, and I take the dividend divided by K minus P to get the new stock price. And then once again, I can actually just go here, say Format Painter, to paint it in the currency format, and I can just pull this across to easily answer the rest of these. Okay, so that's not working. Why is that not working? Well, because I need to calculate the D1 for all these variables first, and then they'll calculate. Okay, now the zero growth model is the simplest model, where I'm just taking D0, and since there's no growth, the dividend is always D0, divided by K to get the stock price. Again, let me just bring the painter down here, and then move this forward. Okay, so that's the first workbook. The second workbook is the variable growth workbook, and this workbook is a little trickier. So what we have here is, so example 1, the variable growth model. So this is if the dividends grow at a variable percentage wise. So in this first problem, we have the dividends growing at 18%. So I'm going to have to escalate this dividend D0 at 18% for each of these years. So I'm just going to take D0 and I'm going to multiply by 1 plus G. Now, in order for me to copy this down, I'm just going to lock in by hitting F4. I can lock in B4 here. This is the B4 I want to lock in. If I have that locked in, actually no, I don't have to lock that in because I'm just escalating. So I can copy this formula straight down without locking it in. So I can just kind of go like that. Let's bring that down. Okay. So we get the D1, basically 18% increase from $3 to $3.58, and then $3.54, and $3.54 to $4.18 is another 18% increase, and another 18% increase. So there are future dividends. So now to calculate the present value, I want to calculate the present value, which is step 2, is to calculate the present value. So you know what? Let me highlight step 2 into a different color, so we know that we're talking about a separate step. So what I'm going to do here is I'm going to use the present value formula. So I'm going to take the dividend and divide it by 1 plus the required rate of return and escalate it by the number of years I want to discount by. Okay, so for the first present value, I'm going to start by taking the D1 and I'm going to divide that by 1 plus R to the exponent 1. So let me just hit enter on that. So let me make this a little bit bigger. Okay. So let me show you again. I mean, I could pull this down to get all the present values, but what I want to do is actually calculate it again. So I would say now that it's larger, you can actually see it better. It's even bigger. Okay. So I'm going to say I'm going to use the present value formula, which would be the, the future amount divided by 1 plus the required rate of return to the exponent using this is the little number, the little character above the 6 key. If you hit Shift 6, makes the exponent. So I'm going to exponent 2. And you see how, now because of the way this is written, I can just pull this down. And I now want to find the sum, the present value of the cash flows. So that is step 2. So here I would just do a little auto sum to calculate that. Okay, so that is step 2. Now step 3. So step 3, I need to calculate D4. So I have the dividend as $4 here, and I want to calculate D4. So here I'm going to do this by escalating at a new rate. So I'm going to escalate it at using this growth factor 2, or G2, would be the new growth. So we had this is why we say variable growth. For the first 3 years, we're growing at 18%. Then the dividend is going to change to $4, and it's going to grow at 4%. So if we're going to calculate this new D4 based on this dividend, I'm going to take D4 and multiply it by 1 plus G2 to get the new variable. Oh, nope. That is, I made a mistake here. This is the dividend in year 4. I had to calculate this. I have to take D3, and that's what I'm escalating. D3 is what I'm escalating to get, because I need to start with D3 to get dividend year 4. And I'm going to multiply that by 1 plus the new growth rate. Okay, so that gives me, so this is dividend in year 0. This is dividend in year 1, 2, 3, and now dividend in year 4. This is dividend year 4. And this is growing at not 18 but 4%, and the required rate of return is still 9%. So now I'm going to calculate the present value. And again, since this is step 3, let's make these a different color so we know that we're working on step 3. Okay, so I want to calculate the present value, and again I'm going to take this and divide it by 1 plus the required rate of return to the exponent of the dividend year, which is 4. So we get 363 would be the present value. So the stock price, when we want to calculate the stock price, so what are we going to do to calculate the stock price? Well, remember that we have different, there's the formula up there, we have different methods. We're going to use the valuation methods we saw before. So I'm going to take the dividend and I'm going to divide it by, so I'm going to take B11, the dividend, I'm going to divide it by D11, which is the required rate of return, minus C11, which is the growth rate. So again, if we look back over here, these are the valuation model that we're working with. K minus G, D1 divided by K minus G. So we're using that same model over here. So I'm going to say this divided by, now R is going to be our K minus G. So R and K are really the same variable. Okay, so we get a stock price of 102. So now let's figure out, this is in our stock price. What about our stock price at year 3, or P3? How would we calculate that? So here we would use, we're going to use B11. Nope. We have to use, we will use the C12, which is the stock price, and then we're going to divide it by 1 plus D11, which is the required rate of return, to the exponent of 3. And this will basically discount or find the present value of our stock price, discounting it for the required rate of return. So again, we're going to take the stock price in the P that we just calculated, and we're going to divide by 1 plus R, which is the required rate of return, to the exponent of 3. That's because we have the P3 here. And this is how we're going to get the, what we would say, the present value of the stock price, or P3. Okay. Okay, so that gives us the P3. So now we want to figure out the present value of the cash flows. So this is step 4. So put this in a different color. We use that color already. This in a different color. Okay, so we're going to calculate the present the cash flow, the present value of the cash flows. So we're basically going to take, we're just going to take E8. This is going to go here and say E8 will be the present value of the cash flows. So see how that's the same symbol. And then present value of P3, we know that we calculated that right here, but pull that down. So if we want to calculate P0, or the current stock price, we're going to take B14 plus B15. So it's basically saying the present value of the cash flows plus the present value of the stock price should be the current stock price. Okay, so this problem, if you're having trouble following me in this problem, this is detailed in the textbook, and it's also most likely going to be a homework problem from the textbook as well in the homework manager. So this is how you could solve it using Excel. And as of the just get the current edition. As of the 14th edition, you know, if you want to figure out so look for chapter 7 and look for the section that says variable growth model, and in the 14th edition it's page 288 to 290 to get a better review of this. But here's basically how I set up in the spreadsheet to calculate. It's a more challenging valuation model in chapter 7. Okay, so there's an exercise problem, a spreadsheet exercise problem at the end of chapter 7 that I've put into the spreadsheet here. And again, we want to calculate the stock price using, so here they give you another model, the common, you know, so they give you a P0 model for calculating the stock price. So you just use the inputs from described up here that were rewritten here. So I rewrote them out to give you D0, G, and R, and so these are the variables you use in this formula to calculate the model. And there's the required rate of return, which would be the risk-free rate plus the risk premium. And again, I put those here together. And then finally, we use this model again to calculate the price 1 year later if the required rate of return goes to 0, and the G is 7, and the D0 is 3.1. So this, again, are pretty simple to follow, but this is sort of the end of the spreadsheet model. I'm not going to actually put the calculations here because it's relatively easy to put together. Now here's another model called the free cash flow model. So the free cash flow model, we're going to calculate here. Now this is again in the textbook under free cash flow model, and it's it can be a little tricky because it's a little long to work with. But what we're talking about here, and let me make this bigger so we could see what we're working with here. This is the free cash flow model. Okay, so what we have here is the growth rate, and this is from, the problem would denote growth rate is 3%, and so that would be, the variable here is G. Weighted average cost of capital, and this is basically, our K or R variable. The market value of debt, the market value of preferred stock, and the outstanding common stock shares outstanding. So now this is really not a dollar amount. This is the number of shares outstanding. So this is really a number, not a dollar amount. Okay, so our free cash flow, if we look at our free cash flow from year 2016, 400,000, 450, 520, 560, 600,000. Okay, so step one is to calculate the free cash flow from 2021. So we want to calculate that free cash flow, and the way to do it is we're going to take B13 and we're going to multiply 1 plus B2 divided by B3 minus B2, and that formula is basically free cash flow 2021 divided by the rate minus the growth factor. So here what we're going to do is actually I'm going to take, it's actually B14. So I'm going to start with the future cash flow from 2021. That's what we're trying to calculate. So we have the cash flow from 2020, but we want to calculate 2021. So we're going to start with 2020, okay? And then we're going to divide that by the, well, first we have to escalate that. So let's escalate that by the growth factor. So we're going to multiply that by 1 plus, and our growth factor here is G, 3. So first that's going to give us our free cash flow for 2021. Because I'm taking 2020, I'm escalating it by 3%. Now to get the to infinity part, I'm going to have to next divide by our weighted average cost of capital, or what could be also known as our R, and I'm going to subtract our growth rate, which is 3%, to get our value. Okay, so just have to put in need a couple of other parentheses here between these. Let's see, 1, 2, 3. Okay, so that worked. You can see the formula here. I just had it's the correct formula. I just had to balance out the number of parentheses. So if I have 1, 2, 3 open parentheses, I have to have 1, 2, 3 closed parentheses. So this is how you would calculate. And again, this is also written out in the textbook. Okay, so now moving from here, this is our step 1, free cash flow to infinity. 2021 to infinity would be, this would be our free cash flow. So then we would move, and this exact first problem here is number for number spelled out in the textbook. So you could follow along by looking in the textbook, and it starts on page 291, and this part, step 1, is on 292, the 4th 13th edition. So if I'm confusing it all through the spreadsheet review, go right to the textbook, and the pages also write out the numbers and the formulas directly. Okay, so step 2, add the present value of free cash flow from 2021 to infinity to the cash flow of 2020. So in step 2, I'm going to have to now add these two, which is simply just adding these. I'm just adding these two cells. I'm taking cash flow to infinity, and I'm adding to it the cash flow from 2020. So I get the 10,900,000. Okay, moving to step 3. Here's the formula for step 3. So we're basically finding the present value of the free cash flow. So in here, I have the free cash flows laid out. So what we're going to do in year 5 is I'm going to just bring this number down. This becomes our year 5 number. So here we have, and these are coming from up here, 2016 to 2019 I put in here, and then I'm using this new number we created in step 2 for our 2020. Okay, so 1 plus r to t, this is calculating our factor. So if we calculate, let's just go plus 1, actually parentheses, 1 plus r. So we know we have r up here. Close parentheses using the caret, which is the icon above the number 6 key, using shift to get that, and this is our exponent. Okay. Now I'm going to lock down B4 with dollar signs because that's our 9%. So I can just pull this down to get our factor for all the years. And these are our factors. Now to get the present value, I just have to multiply the free cash flow times the factor. Oh, that is divide. I got to divide. Should be smaller. There we go. Much better. So I divide. So for each of these, I take our free cash flow and divide by our rate. But I don't have to do these individually. I can just kind of scroll up a little bit. I can move these down. Okay, so that gives me, for the entire problem, what we call the value of the entire company, V to the C, gives me 8,628,000. And this number might be off by 2,000 from the textbook. Okay, now, so moving on to step 4, we want to calculate V to the S. So what we need to do is bring in our V to the C. Here's the formula right here. So we're going to bring in our V to the C. Okay, and then we need our V to the D, which is the value of the preferred V to the D and V to the P. So if we go back up here, D stands for debt. So V to the D is going to be our debt, and V to the P is going to be a value of our preferred stock. So just bring that there. Okay. So now we have our value of the company, value of the debt, and value of the preferred stock. So if we just, oops, I gotta move up. I remember. I'm not sure if you so to get this final formula, I just follow this formula up here, and I take V to the C minus V to the D minus V to the P, and I get the answer, which is 4,728,000. Again, the book might say 4,726,000. The book is wrong. My numbers are right because I proved it in Excel. All right, so that's how you would calculate using this free cash flow model, which is rather, I put the textbook pages here because you really need to read the textbook and then kind of review this video to see how this works. And I have a second example here for you to try by yourself. I'm not going to walk you through it step by step, and that will calculate the problems from chapter 7, which you're likely to see in the My Pearson, My Finance Lab homework and on the exam. Okay. So let me go back to the valuation model, and that is the help for Chapter 7 stock valuation models. Thank you.